Hello, and welcome to the Joss Brown Podcast. With over 40 years of combined financial planning experience, we will discuss our favorite topics, concepts, and stories.
Well, hello, and welcome back to the Joss Brown Wealth Advisors Podcast. I'm Phillip Saunders.
I'm Dan Joss.
And today we'll be talking about a Morningstar article that Dan actually found. It's called "What's the Surest Route to Investing Excellence?" It's by Jeffrey Ptak, and it was written on February 22nd, 2023. So really this article is about kind of the psychology behind investing and how to get the most out of your investments. So what were your first thoughts about that article?
It kind of highlighted a few things that we do in our normal day-to-day investing.
Yeah.
And so, I saw you write down some bullets there. So let's just go through some of those, and we'll show you how it applies to our philosophy. And you can look back at our other podcasts on our investment philosophy, and you'll see how we can apply the philosophy to an article and either say there's valid points in this article, or like a lot of news in the finance world, it's just fluff and really doesn't mean anything.
Yeah, that's right. Yeah, so the first thing to go into is the difference between investing and saving. So what Jeffrey was saying was that saving is more important than what you invest in, the actual investment vehicles that you're buying. And so starting early, saving is the most important thing, much more important than buying the actual investment.
Right. And so 35 years ago now, I was in the Army, and I was at Fort Bragg, and someone said, go see Captain Joss. He'll give you some investment advice. And so I kind of was listening to this conversation, and the guy ended up coming over asking me essentially for a stock pick.
Yeah.
What's the great advice for him? And I said, how much can you set aside every month for investing? He thought he could save about $200 a month. I said, okay, now it's July. I said, in December, come back with me with that $1,200, and I'll give you a recommendation.
Yeah.
And you know what happened.
He didn't come back.
He didn't come back.
Yeah.
He couldn't save $200 a month. And so why would we want to put his hard-earned money in the stock market, which could lose, right? Last year, growth stocks lost 40% of their value.
Yeah.
And if a person can't save, then we're not going to recommend they invest.
That's right.
And so that works. It's like, well, yeah, that's obvious, but it's not obvious because
right.
people want the fancy, right, before the boring.
That's right.
So
they want that stock pick.
That's a great point.
Yeah. I've found what works best for me and for our clients is just automating that process. And so that means, just monthly, that $200, boom, into the investment account or whatever it is.
Right. And so what I tell new investors, typically children or grandchildren of clients, is let's start putting money into what we would call an emergency fund. And when you get it to a certain amount, then let's say it's $200 a month, although that was $200 a month 30 years ago. So
Yeah.
let's still use the $200. $200 a month for 6 months to get it to $1,200, and then if that works as an emergency fund, then we put the $200 into an investment of some sort. But we still have the $1,200 setting aside. And we can apply that to any client. A doctor we have many doctor clients that are paying off student loans, and they have a good salary, and we say, let's pay off the car, let's set some aside for an emergency, and that could be a $50,000 emergency. Then we start the investing, either the 403B or SEP retirement account, or after tax, or make extra payments on the mortgage. I mean, there's lots of things to do, but if you can't set aside money to do something else with every pay period, then you shouldn't be investing.
Yeah. You just have to set that in
And
practice.
once you have the emergency fund, then we already know, because you have an emergency fund, you also have the ability to keep setting something aside.
That's right.
And then it's our problem is to figure out where best it should be set aside.
That's right.
Reduce debt, add to a retirement account, add to investments that are outside of a retirement account, give it away. Many of our clients are generous and give regularly. Well, that's the same thing as saving. You're setting it aside. You're not spending it on yourself.
Yeah.
So, good point. What else?
Great. Oh, the next kind of topic he went into was choosing funds versus just diversifying in the total market. And so the little chart that he showed was the percentage of fund returns that investors actually received. And most of the time, the fund may have returned 10%. The investor only received 5% of that return. So either they bought it later, they sold it earlier, vice versa, and it just didn't work out. And so what his argument is that just buy the fund and hold long term.
Yep. Mutual funds or even individual stocks report on a calendar basis or something like that, regular reporting cycle. And so we could go back and say in 2021 we got this return, or 2022 we got this return. What he was saying is nobody holds it the calendar year. They either buy part of that or they buy it after it was in a magazine saying this is the best one to have. And so that's when they buy it, which studies have shown if a company or a mutual fund or an investment is best one year, it's likely to not be the best the next year.
Yeah.
Right. So they get the bad performance and then they sell it. So they were in at the top and down at the bottom, but they didn't hold it the entire period. So they didn't get the return of the fund, but that was their return they got in that fund.
Yep.
And Carl Richards has done a lot of talking about this, and he kind of coined the phrase behavior gap. That's what this author was describing. It's like
The behavior gap.
they got this in the investment. The investor got this because of their behavior. They didn't get what the fund
And then
got.
the difference is the behavior gap.
Yeah, the behavior gap is where I made my mistake.
Yeah. Yeah, that's what you didn't get.
Yeah, there's rarely positive, rarely is there outperformance
Yeah.
because of behavior. It's usually underperformance because of behavior.
Yeah. Yeah. Yeah, that feeds right into the next point he goes into is the difference between trading and rebalancing. And so what we do is we set an initial allocation for what we think the client should be invested in. And then as new money comes in or as the stock market changes, we rebalance and we go back to that original allocation. The difference would be, the mistake would be just trading. And so a lot of clients would, not clients, but individual investors would say, okay, whatever's done well, I'll just keep buying that. And when you do that, you're not invested in the whole market. You're not allocated properly. You're just buying what's done well in the past, and that may not be necessarily what outperforms in the future.
Right, and that's the warning on all the fine print. Past performance is not
No guarantee.
No guarantee. Yeah, not indicative of what's going to happen.
Yeah.
But this is a free country, we can all invest how we want to invest, right?
That's right.
And so sometimes a few more shares of that or some more of that because it did well, and it's not a bad thing. It's just not our philosophy.
Yeah.
And it's hard to do, our philosophy. Rebalancing means selling what's done well and it's out over target and buying something that's under target.
That's
which
right.
Means it may not have just done as good. It may have done poorly. And you're telling somebody to buy that.
Yeah.
And we've been doing this a while. And we'll show returns for 10 or 15 different investments in a portfolio, and they'll say, well, why do I want more of that one that was actually the worst? Well, because our investment philosophy of rebalancing.
Yeah.
We believe it will do well over time. It's just that because we have 7 or 8 or 10 different investments that do well over time, they don't do well at the same time. And they usually don't do poorly at the same time.
That's right.
And that's why we're buying more of a good investment that just happens to not be doing well right now.
And that's part of the reason we designed it that way,
Right.
is because some things be doing well, some things may not, but it's a couple of things there. One is that when this is doing poorly, this is doing well, and that means if we're taking distributions, we can sell what's up, right? But it also means that we're diversified across the total market, and that reduces our risk. Because
Right.
something may be up, something may be down, and so our portfolio isn't as volatile as something that may be going down.
And it can go on a long time.
Yeah.
International stocks did very well in the 80s, the 90s, U.S. stocks did well. Large U.S. did really well until 2000.
Yeah.
When 2000 to 2002, it dropped 40%. They dropped 40% again in 2007, 8, and 9. And large U.S. stocks ended that decade, 2000 to 2010, less than 0.5% above where it started.
Yeah.
But REITs were positive that decade, and small company stocks did well. And then this past decade, 2010 to 20, large U.S. stocks did well and outperformed small or international.
Yeah.
And then this year to date, international is outperforming U.S. So they each are good investments over the long run, but at different times they perform differently.
Yeah, I thought it was interesting in researching for this podcast. I looked at international stock returns, specifically the international MSCI World ex-US, so all the non-US stocks. And I'm sure you lived through this. I lived through this too, but I wasn't doing this. In the years, I was in elementary school at this point. In the years 03 to 07, that index had returns of 41%, 21%, 17%, 27%, and then 17%.
Yeah, great years.
So, yeah, great years. And I don't think the U.S. stock market was at that level at that time. So,
or parts of it. And even with the U.S., just large and small. Large lost 10% in 2000, 12% in 2001, and 22% in 2002, the S&P 500.
Right.
And small was positive 2 of those 3 years. So you just can't say the U.S. market.
It's the story within the story.
Yeah. And what's frustrating for me is you hear on the news or on the radio on the way home, it's like the Dow Jones, the S&P 500, and NASDAQ. It's like, well, those are all large cap stocks.
Yeah.
And some are more growthy than others, but no mention of small or REITs or international or anything else in the portfolio, in our portfolios.
That's right. Yeah, the next thing would just be the yield of stocks. So a lot of people can tend to get hung up on the dividend-paying stocks versus those that are growing well.
Well, dividends provide income. Income can be reinvested.
That's right.
But yeah, we invest with an eye towards total return.
Yeah.
And we recognize that dividend income is part of the total return. In fact, if you look over history of the stock market, stocks pay about 9.8 or 10% per year, over the last 100 years plus.
But that other percentage, that 6 or 7%, is just
real.
The growth.
Yeah, it's real.
Yeah.
It's appreciation.
Yeah.
Yeah. And we could pay long-term capital gains on that. And if it's in an IRA, we'll take the gain regardless of how it gets there.
That's right.
And rebalance with it. Or use it to spend.
Yeah.
Or buy that important item, whatever that is.
Yeah.
Good.
A lot of options.
Yeah.
Well, I think that's all we have for this podcast.
Well, that's good. Well, so how we think when we read an article is, how does it apply to our philosophy? How does it happen to, how does it impact our clients? Because our clients are reading these things too. And so we're going to use this podcast as an opportunity to explain where we see some good articles and maybe some not so good articles in the future. Good?
Yeah. Thank you.
All right. Thank you.